Hi guys, welcome back to the artoftrading.net. This is Stewie with you here. I want to do a video, hopefully not too long of a video. I just want to talk, briefly about something I discuss all the time, in the chat room and also to my members a lot. And I use the word under the surface. I use the words under the surface all the time. And I just want to just kind of go over exactly what I mean by that. I always talk about like, when breakouts fail or when breakouts are working, or momentum is strong, momentum is working, or under the surface strength or under the surface weakness, in comparison to the indexes, So I want to go over exactly what I mean by that. So, many of you might have heard me, using the words, I like to track the market of stocks. So I don't like to track the stock market. I like to track the market of stocks. Now, what does that mean exactly? Basically, it means, rather than me tracking, the Dow Jones or tracking, the Nasdaq or the S&P 500 only, which is not, by the way, there's nothing wrong with that. However, that's not what I like to look for. I like to dig down deeper, like a mechanic, who trying to fix the car. He cannot tell you what's wrong with the car or what's right with the car just by looking at it from the outside. The mechanic would like to get inside, take a look at the engine, take a look at, the transmission, the brakes, he likes to get in deep inside the mechanics of the car, inside the engine of the car, and then tell you if this is a good car or a bad car. So this is exactly what I'm trying to do here with, this is exactly what I try to do here is I try to look for the mechanics of the market, the inside workings of the market. Are they working? Are they not working? Are they stalling? Is momentum strong under the surface? Are stocks moving strongly? Are they weakening? Are they failing? So let's go over quickly what I mean by that. So over the last few weeks, what I've been noticing is the market has been going higher. Okay, there's nobody can deny that. It's been a great start to 2012. However, over the last few weeks, what we've been noticing is a large number of stocks, that make breakout moves and then stall out, or they fail. So it makes it very hard, to find stocks that are working. Other than just a handful of stocks like Apple, for example, or just a select few stocks that keep running hard. Every dip keeps being bought. But the market is not just Apple. The market is not just one or two other names. I mean, some traders might just buy these one or two, three stocks and hold them, but really, I mean, eventually these stocks will eventually top out as well too, and then they become like any other stock. But the bottom line is, the market is made up of stocks, and this is what you want to be looking for is how are these stocks doing in relation to the market in general. So as you can see here, I'm going to pull up a chart of Broadcom. This is a chart that I put up a few days ago here for the artoftrading.net members as a breakout play. And as you can see here, I gave it on Monday, and as you can see here, the stock broke out on Tuesday right here. So it broke out. The trigger to enter was 39. As you can see, quickly it shot from 39 to 39.60 quickly in the morning. It was a quick rally right out of the gate, and it came back down right here. See that? So it closed poorly, as you can see here on this candle. Look at this upside down T looking candle. So it opened over 39, so it worked nicely if you bought it right at 39, and it quickly went to 39.66. So it was, it was a good fast gain, but this is not what you really want to see. You want to see a stock breakout and then keep running. You don't want to see a stock breakout and then fall back down right away. This makes it very hard, to play these kind of breakout plays. So as you can see here, it broke out, failed, it's closed, in a poor looking candle, and then now the next day today it's closed. It's opened lower, and it's continuing to fall here. So this is my example of a failed breakout. So right away, that's a warning sign, especially on a big common stock like Broadcom, a stock that many people like to follow. So here another stock, a lesser known one, would be SWI, and as you can see here, the stock made a nice breakout here over 40, that 40 area, 40 50 area. It shot up nicely to 42, but guess what, I mean, if you bought it here, hoping for a multi-day run, which is what I expect, from these breakout plays, you can see here the stock made a nice little run on on this breakout, and then 2 days later it just failed again. So I mean, this is very, very frustrating to play, if you are trying to play these swing trading, breakout plays. So right away you have another failed breakout here. So let's take a look at another one here. Is CAT. This is a very, very Caterpillar, very, very popular stock. Everyone likes to track it. It tells you, like, it's a good indication of market health, when CAT is doing well. And if it's not doing well, then it's something that you need to pay attention to, because it's a good indicator of what's going on in the economy. So a lot of people track this stock. I mean, as you can see here, the stock made a really good run here throughout, December, January, February, March, and then around end of February, you can see how the stock started to top out here. You started to see a big heavy selling here. The stock came back down, crashed to the 50-day moving average, and then bounced. Very, very weak bounce. You can see here the volume was very weak. You look at that heavy volume selling, and then weak volume on the way up. And you can see here it made a lower high here. So it had a high here, a lower high here, and it came crashing down here again on very heavy volume. Check out this volume here. So on the down days, the volume has been very heavy. On the up days, the volume has been very low, as you can see here. So it had a weak bounce to retest the 50-day moving average, and it came back down crashing today. And as you can see, guys, look at this. It's breaking through some area of support here around the 105 area. So it's breaking through it. This is not a good sign. This is not the kind of stock you want to be long in, as a stock is, retest the 50-day moving average here on the back line, and then reverses and then breaks down here. So I mean, next support on the stock is not till around the 100 to 77 area, 97 area. So you can see it has quite a few thin air, as they like to say, before the next area of support comes in. So this is not the kind of stock you want to be looking to long here. So this is another warning sign that I see under the surface. So again, under the surface, if this rally was indeed healthy, you will see stocks like Caterpillar, acting like this, like they did back in December and January and February. You want to see it go straight up like that. So as of right now, I'm not sure. Some people might call it topping out. To me, it looks like a topping out pattern, simply because of the heavy volume selling here. But like any topping out pattern, eventually it will find some support, and then it will start another rally. But in the meantime, you don't want to be trying to catch this knife. Let it settle down, let it find a support, let it build a base. Then look to go long. Trying to catch a falling knife and guessing where the thing might bottom is not a good idea. It's not a strategy that I like to use personally, at least. So you can see here as it's breaking support, let it settle down, let it show you where the stock wants to bottom, maybe around 100, maybe around 97.50, 97 area, who knows. Just give it time, it will tell you. Let's move on to UTX. This is a trade that we did here at the Art of Trading a few days ago, and I took the trade because I saw that the stock made a new high here, and it came pulling back down for several days in a row. 1, 2, 3, 4, 5, 6 days in a row it pulled back. So we bought it here around the 82 area with a stop loss at 81. I put a stop loss right below the support level here at 81. Bought at 82, stop at 81. And we bought it I think on Thursday, held it through Friday, made a small inside day here, and it rallied and it bounced right back, and I decided to sell it at around 83.30, 83.40, around that area right there, just because it started to retest the 20-day moving average. See that? So we bought it on a test of the 50-day after several days of being down, held support, and then Monday we had a big day in the market, took advantage, and then sold it on strength. And luckily it worked out really well for us, because right after we sold it near the top as it was testing the 20-day moving average. And now look, guys, it's starting to roll over again. So now actually what we're looking at here is a potential head and shoulder top in UTX. So once again, this is a very, very, very common popular stock that many people like to follow. It's a Dow Industrial. But as you can see here, guys, it's a potential head and shoulder top with support around that 81 area. So a break below 81, and I would consider this one as a short setup. So something to be aware of. So this is one stock we need to watch here very carefully as a short setup actually. And as you can see here, you can see the MACD is starting to roll over here. As you can see that, look at this, guys. It's crossed over here. It's crossed over to the downside. It's starting to make a high. There's a high here, and then there's a lower high over here on the MACD. There's some very heavy volume selling here, so that tells you that the stock is probably slowly but surely topping out. So this could be a short setup here. Okay, moving on to another one is this one is Buffalo Wild Wings. It's another stock, you know, that I had on Monday. It popped on my scans because it had a big strong day on Monday. It broke out to new highs here over that 94.41 area. It had a big day here, and as you can see, guys, it broke out, and then right away on Tuesday and Wednesday it's giving back almost all those gains back. This is a perfect example of what I've been saying, is under the surface we are seeing breakouts that are starting to stall out and fail. So this is not what you want to see in a healthy market. You know, in a healthy market you want to see what the stock did. Look, I mean, compared what it did back when the market was really strong and running quite nicely, healthy, you know, everything working well under the surface back in January and February. Check this out. It broke out here on massive volume, and the stock kept running. Check this out. It kept running nicely. You know, and look here, and it made a breakout here on back in mid-March, and it's failed back down to retest the 20-day moving average. So as you can see here, it's doing it again. It broke out and it's failing again. So this stock, it tells me that maybe chasing strength, you know, or chasing breakouts or playing breakouts, you know, should be maybe it's just for day trading, or maybe 1 or 2 days only. And then maybe, you know, a good strategy might be to buy these stocks as they come back into support. You know, very similar to what we did with the UTX trade, you know, where we did not buy it here as the stock was breaking out. You know, we allowed it to fail, to come back down into support, and then look for a 1 day or a 2 day bounce in the name, and then sell it on strength. You know, so this, I think, could be something very similar to play out, to look for here in Buffalo Wild Wings. Look for the breakout, look for it to fail back into support on the moving averages. Look to buy it as it's sitting on support, and then look to sell it if it bounces. So another name we watch is Select Comfort, SCSS. As you can see here, guys, one more example of a failed breakout that we saw this week. You can see here the stock broke out over 33.50, 33.60 area. You know, made a small run, and then quickly turns around and fails back down. One thing that worries me about the stock is this big volume sell-off here. This big volume sell-off right here tells me that you know, maybe the stock might be in the early phases of a consolidation or a mini topping out, maybe topping out for a little bit. So watch the stock over the next few days, few weeks. See if maybe it dips back down to the 50-day moving average. As you can see, it's made a huge run, and the 20-day has been good support for a while. But every stock eventually will have to test the 50-day moving average. So maybe this stock might be headed there next. So something to keep an eye on. Anyway, guys, just want to do a quick video just to show you exactly what I mean by under the surface. You know, also another example I like to use is, you know, I like to look at stocks on my watch list. Here's something like I would normally look for, guys. You know, I have a watch list of, you know, 20, 30 stocks which I watch regularly. And as you can see here, when we opened early in the morning, you know, we saw a lot of stocks open in the red. You know, so that to me, and even though the market went green very, very briefly today, you know, it was not something you want to get. I was excited about because a lot of my watch list open in the red. You know, so this is a perfect example of what, you know, when stocks open, the stock market opens higher, but under the surface. In other words, your watch, let's say you have a watch list of 20, 30 stocks, If the majority of them are opening lower or down, that tells you that you need to be very, very careful about taking up new positions on the long side, because the market is actually weaker than what we are actually seeing. So as you can see here on this watch list of 25, 30 stocks, only 1, 2, 3, 4 stocks are trading higher, and the rest are trading down. So I mean, this is not what you want to see. If you want to go aggressively long, or so you have to be very careful. As you can see now, the Dow is down about 92 points. S&P down to about 12. It's right at 1400. So and you can see here, this is a stock, eBay, another stock that we were looking to play a few days ago. And you can see here we played on a breakout right here above 38. We bought at 37.90, an anticipation breakout. So it did break out. It went to about 38.20, 38.15, and quickly reversed back down and failing. Look at this, guys. So now it's back in the low 37s, and we sold it for a small gain just because I noticed that it was stalling out, which is not what you want to see on a breakout. Once you see a breakout work and then starts to stall out, this is not what you want to see, and you want to look to exit a position once the breakout starts to stall out like that. Sometimes you do sell too soon and the stocks keep running, but in general, I'm a big believer in safety first. If something doesn't feel right, if it's not working, sell it and then reevaluate later from the sidelines. I have no problem buying a stock back if it can prove to me that, hey, this time it's going to work. So I don't mind selling a stock for a small loss or a small gain, and just to watch it run away from me later. That's fine. I mean, as long as I'm disciplined and I'm not risking money, running after setups that might or might not work. So in this example, we got very lucky. We bought at 37.90, sold it on 38.05, so a tiny little gain, but we sold it because it was stalling out. And indeed, look at that, guys. The next day, eBay tanks, and now it's in the low 37s. So it was a good trade to exit, just simply because the stock seemed like it was stalling out. So this is another example of learning to read between the lines, learning to read the action under the surface. This is exactly what I'm trying to explain here, is learn to observe the tape. What is the tape trying to tell you? If we bought eBay at 37.90, and the next day it gaps up at 38.20 and then keeps running, this is exactly what you want to see. You keep raising your stops and you hope for a big winner. If you buy at 37.90, opens at 37.70 and starts to flop around for a few hours, it's hesitant, it's not sure of itself, sell it, get out, and then reevaluate later. So anyway, I hope this helps, guys. And I promise I will do more videos on the future about how to read underneath the surface. This is just a basic 101 a lesson of what I like to look for stocks and how they behave under the surface. I like to look for stocks, if stocks have a failed breakout like they do here on eBay Classic. It broke out over 38 and it quickly started to stall out, and now it's completely failed. This to me is a warning sign that the market is not as healthy as I would like it to be. That does not mean you have to be bearish. That does not mean that we're gonna crash. That's not what it means at all. It just means that the market is acting tired. It needs a rest. It needs a break. So just let it hang out. Let it do its thing. You don't have to be aggressive every day in the market. Not every day is a day to trade. You just learn how to just pick your moments. Pick when you have an edge. Pick when stocks look prime to set up to explode, and then look to position there. If the setups are not there, if the setups are not working, there's no reason to rush into the market. There's no reason to be aggressive. So just wait for your moment. Wait for the stocks to set up. Wait for your style of trading, for the setups that match your style of trading to come to life. Whether you're a dip buyer, wait for your chances. Whether you're an aggressive momentum trader, wait for your chances to come. Whether you like to trade breakouts only, whether you like to short only, there's a market for everybody. You just have to wait for your time to come. So it just takes patience, and just the belief that your time will come, and you just have to wait for it. And in the meantime, just play it safe, be disciplined. You worked hard for your money. Don't waste it by going after average or mediocre setups. Just aim to look for the best setups the market has to offer you. Do your homework, and look for volume, look for strong volume on these breakouts. If the volume is not there, try not to take them. And hopefully this helps, guys. Okay, I'll talk to you soon.